You see them everywhere. The investor posting portfolio screenshots on social media. The trader with the luxury watch and the leased sports car. They look successful. They talk about their gains. They project wealth. But here's what you don't see. The margin calls, the maxed out credit cards, the portfolio that's actually smaller than it was 5 years ago. Looking wealthy and being wealthy are not just different strategies. They're opposite strategies. And the gap between them is destroying more portfolios than any market crash ever could. Today, we're breaking down the 3 critical mistakes that separate fake rich investors from real rich investors. Because if you're making these mistakes, you're not building wealth. You're building an illusion that will eventually collapse. The lifestyle inflation death spiral. The first trap is the most seductive. Your portfolio grows by 20%. You feel wealthy, so you upgrade your life to match that feeling. New car, better apartment, expensive dinners, premium subscriptions. After all, you earned it, right? Here's the problem. That 20% gain in your portfolio somehow becomes a 40% increase in your spending. The mathematics don't work, but the psychology is powerful. Fake rich investors treat unrealized gains like paychecks. They see their account balance go up and immediately start spending as if that money is locked in forever. But markets move both directions. Real rich investors do the opposite. They maintain a fixed lifestyle regardless of portfolio performance. When their investments grow, the gap between their income and their expenses grows with it. That gap is where actual wealth lives. Think about compound interest. You know it works for investments, but it works for spending too. When your lifestyle expenses compound faster than your investment returns, you're running backward while thinking you're moving forward. Let me show you what this looks like over time. 2 investors start with the same portfolio, same returns, same market conditions. 10 years later, one has built substantial wealth. The other is barely ahead of where they started. The difference? Investor 1 kept their lifestyle stable. Every gain stayed in the portfolio, compounding. Investor 2 upgraded their lifestyle with every market rally. Every gain got spent, leaving nothing to compound. The math is brutal. If you're spending your gains, you're not just missing out on future returns. You're actively preventing wealth accumulation. And there's a psychological accelerant making this worse. Social media. The pressure to display success. To show you're winning. To prove your investment strategy is working by upgrading your visible lifestyle. But real wealth is invisible. It sits in accounts, compounding quietly. It doesn't drive a luxury car or wear a Rolex. It grows in the gap between what you could spend and what you actually spend. The fake rich investor needs everyone to know they're successful. The real rich investor doesn't care what anyone thinks because they're focused on a different scorecard entirely. This is why lifestyle inflation is the first wealth destroyer. It turns temporary portfolio gains into permanent spending commitments. And once your lifestyle expenses lock in at a higher level, cutting back feels like failure. You're not building wealth at that point. You're building a treadmill that runs faster every year, requiring bigger and bigger returns just to maintain the illusion. But lifestyle inflation is just the surface problem. The real damage happens in how fake rich investors approach the market itself. The trading addiction and fee hemorrhage. The second trap looks like action, looks like engagement, looks like you're actively managing your wealth. But constant trading is not wealth management. It's wealth destruction disguised as sophistication. Fake rich investors are always moving, buying the hot stock everyone's talking about, selling when they hear negative news, switching from growth to value and back again, jumping between investment strategies based on what worked last quarter. All this activity creates a powerful illusion. You're doing something. You're engaged. You're not just sitting there letting the market happen to you. But here's what actually happens. Every trade costs you. Not just the obvious trading fees, though those add up faster than you think. There's the bid-ask spread, the tax inefficiency of short-term capital gains, the opportunity cost of being out of the market while you're repositioning. Real rich investors understand something fundamental. Strategic inaction is a position. Doing nothing is often the highest return strategy available. When you let compound interest work without interruption, When you hold quality investments through volatility instead of trading around it, you capture returns that active traders never see. There's data on this. The investors who perform worst are the ones who trade most frequently, not because they're picking bad investments, because they're picking good investments and then abandoning them before the returns materialize. The timing trap is particularly brutal. You try to catch every market move, sell before the downturn, buy before the rally, but you miss the 10 best days in the market and your returns get cut in half. Miss the 20 best days and you would have been better off in cash. Those best days? They're usually right after the worst days. The days when fake rich investors panic and sell. Then there's the diversification mistake. Fake rich investors confuse diversification with dilution. They own 40 different positions because they heard diversification reduces risk. But what they've actually done is guaranteed mediocre returns. Real rich investors practice strategic concentration. They understand their best ideas deeply. They size positions appropriately. They know that owning too many investments means you don't really understand any of them. And there's the guru hopping cycle. This month you're following the value investor who's been crushing it. Next month you're switching to the growth strategy that just had a hot quarter. You're constantly changing your investment philosophy based on recent performance. But investment strategies work in cycles. Value outperforms, then growth outperforms, then value again. By the time you notice what's working and switch to it, you're buying at the peak of that cycle. Real rich investors pick a sound strategy and stick with it through multiple market cycles. They understand that consistency compounds. Strategy hopping guarantees you'll always be buying high and selling low. The fake rich investor's account looks busy. Lots of activity, lots of trades, lots of strategy shifts. But at the end of the decade, the returns are disappointing. All that activity generated fees, taxes, and missed opportunities, not wealth. These trading mistakes compound with the third trap, the one that locks investors into fake rich status permanently. Section 3. The debt leverage delusion. The third trap is the most dangerous because it can wipe you out completely. Fake rich investors love leverage. They borrow against their portfolio to fund their lifestyle. They use margin to amplify their trading. They take out loans secured by their investments to buy things that don't produce income. The logic seems sound. Why sell investments and trigger taxes when you can borrow against them? Why limit your lifestyle to your actual income when you have all this portfolio value sitting there? Here's why. Because leverage turns corrections into catastrophes. When the market drops 20% and you're not leveraged, you're down 20%. Painful, but survivable. You can hold and wait for recovery. When the market drops 20% and you're leveraged, you get margin calls. You're forced to sell at the bottom. You lock in losses. And if you've borrowed enough, you can lose everything, even though the market only dropped 20%. Real rich investors use debt strategically. They borrow to acquire income-producing assets. Real estate that generates cash flow. Business investments with clear return profiles. Never for consumption. Never to fund lifestyle. There's a particularly insidious version of this trap. The investor who carries credit card debt at 20% interest while keeping money in investments earning 8% returns. The math is simple. You're paying 20% and earning 8%. You're losing 12% on that money. But the psychology is powerful. Selling investments feels like admitting defeat, like you're not really wealthy. So the fake rich investor keeps the investment account intact for appearances while hemorrhaging wealth through interest payments. This is the reverse compound effect. Your debt interest erases your investment gains. And if your debt is growing faster than your investments, you're moving backward while your account balance makes you think you're moving forward. Breaking this cycle requires a strategic shift. From fake rich behavior to real rich behavior. From appearance to substance. From activity to patience. It means keeping your lifestyle fixed regardless of portfolio performance. It means holding quality investments instead of constantly trading. It means using debt strategically or not at all. Conclusion. The strategic pivot. Real wealth is built through the gap between what you earn and what you spend. Not through appearances, not through activity, not through leverage. The investors who look wealthy on social media are often the ones going broke. The investors building actual wealth are invisible because they're focused on the right scorecard. Audit your last 90 days. Are you trading too much? Spending your gains? Using leverage to fund lifestyle? If so, you're in the fake rich trap. Subscribe for more wealth-building strategies that focus on substance over appearance.